The stock market is near an all-time high, and depending on who you listen to, that means one of two things. Either we're at the beginning of an incredible new era for investors, or we're about 3 weeks away from financial Armageddon. There apparently isn't a third option. I think there is, and it lies somewhere in between. Because if we're worried about the market being too expensive, then I think there's a better question we should be asking ourselves. Not, is the market going to crash, but if it does, how am I going to react to it? Am I prepared? And that's what I want to talk about today. I'm not going to try to predict whether the market goes up or down from here. There's already plenty of people on the internet doing that with remarkable confidence. I'll give you a spoiler. They don't know what's going to happen either. Otherwise, they would pick stocks better than those monkeys throwing darts at the Wall Street Journal stock tables. Instead, I want to look at why markets feel expensive. What does that actually tell us about the future? What can we learn from the past? And what can investors actually do when they know there's risk ahead, but have absolutely no idea when that risk will show up? Imagine you're driving down the highway at 70 miles an hour. It's a beautiful day, the road is dry, traffic is moving, everything feels great. Then a few miles ahead, you notice the sky getting darker, really dark. You see storm clouds start to roll in, building up in the distance. You don't know exactly what's ahead. Maybe it's a thunderstorm. Maybe it's just 5 minutes of rain. Maybe the storm moves north and you never see a drop. Weather forecasts, much like market forecasts, have occasionally been known to disappoint. So what do? You probably don't slam on the brakes. I mean, that would be dangerous. You pull onto the shoulder and abandon the car because you saw a cloud. That would be ridiculous, right? But you probably shouldn't keep driving the same way either without being prepared. You pay attention. You get defensive. Maybe you slow down a little bit. You increase the distance between you and the car ahead. You make sure your headlights are on. You prepare for the possibility that the roads will get worse. You adjust the conditions without pretending you know exactly what happens next. And I think that's a pretty good way to think about the stock market today. And I think it's a pretty good way to think about planning for the future, both from an investment and a risk planning standpoint. By several measures, stocks are expensive relative to their historic averages. And there's another unusual feature of today's market that's really worth digging into. When most people say the stock market, they're usually talking about the S&P 500. 500 of America's largest companies. Sounds really diversified. 500 is a large number. If I bought 500 stocks in my portfolio, I would have a long road ahead of analysis, making sure that I understand why each of those stocks fit into the portfolio. Except there's one problem. The S&P 500 is weighted by market capitalization. What does that mean? The bigger the company, the more influence it has on the index. Shameless plug time. I just started a podcast called The Thoughtful Investor. It's on Apple, Spotify, wherever you cast your pods, wherever pods are cast, wherever podcasts happen. In the first episode, I mentioned the 10 largest companies represented roughly 36% in the entire S&P 500. So you can own 500 companies and still have more than a third of your money concentrated in just 10 companies. 2 of them are Google, by the way. So really, it's 9 companies. Google has Class A and C shares taking the 5th and the 7th spot. It's diversification with a really aggressive seeding chart, a wealth divide, if you will. And many of those companies share something else. They're tied directly or indirectly to enormous expectations surrounding technology and artificial intelligence. Now, artificial intelligence may genuinely transform the global economy. It's already started to. The companies leading that transformation may continue producing huge profits. This isn't an argument that NVIDIA or Microsoft or any other company is destined to fail. It's an argument about valuations and price. Because one of the most important lessons in investing is that great companies and great investments are not necessarily the same thing. You can identify one of the greatest businesses in the world, still earn a disappointing return if the price you pay assumes an even greater future. And you can own a boring company that never changes the world and still earns a perfectly good return if the price you paid appropriately reflects its future. As an investor, you have to ask both. Number one, is this a great company? Number two, how much greatness is built into the price. The stock market is known as a leading indicator. So what's a leading indicator? It means that the price is the expectation of future profits and losses. So of course, what's happened recently matters to the investor, but what's supposed to happen into the future, usually around 2 years of future earnings, is priced into what the valuation is today. So future moves in the stock price will be more based on whether they hit or miss those expectations. And that's extremely important when everybody already knows the story. You aren't discovering artificial intelligence before anyone else. Wall Street knows. Institutional investors know about it. Your neighbor knows about it. My children know about it. They're 6 and 10. My friends won't shut up about it. At this point, I'm pretty sure my refrigerator knows about it. So the question isn't simply whether AI succeeds. The question is how much future success investors are already paying for in today's price. And we've seen versions of this before. 15 years ago, the largest company in the S&P 500 wasn't NVIDIA. It wasn't Apple, Microsoft. It was ExxonMobil. Go back further and you'll find companies like General Electric leading the pack. Before that, IBM. Every generation has companies that feel permanent. The technology changes, consumer behavior changes, industries change, capital moves all over the place. Yesterday's champions don't necessarily disappear, but the companies dominating the market today aren't guaranteed to dominate 10 or 20 years from now. ExxonMobil's number 17, by the way, if you're curious. At least it was as of when I did the podcast. The podcast that you should follow. And while I think investors can make a mistake when the market reaches an all-time high, we see high valuations, we see concentration, enormous enthusiasm around new technology, and immediately we feel like we have to do something. The fact is, since 1950, the S&P has closed at record high on roughly 6% of all trading days. Doesn't sound like a huge number, but that's a 1 in 20 of trading days, averaging about 17 to 20 new highs every single year. So you look at years like 2022, when the market doesn't set a single high, because the highest day of the year was January 1st, and it still averages out to 17 to 20. That's remarkable. So, Bryan, what do I do? Do I sell now? Do I wait for a crash? Do I move everything to cash? Do I buy more before it gets even higher? Do I start watching CNBC 8 hours a day and develop strong opinions about the Federal Reserve? Do I get into derivatives and margin? Please, imaginary question asker, calm down. There's another option. You can admit that you don't know. I don't know either. Before all my clients start finding another advisor, I'll have to add that they don't know either. An expensive market doesn't tell us what's going to happen next. Stocks can be expensive and become more expensive. They can become cheaper because corporate earnings grow into their valuations. They can trade sideways for years, or they can fall dramatically. There's a lot of different options. So a lot of people track the price over earnings of the S&P 500 and determine valuations based on that. Two things can happen to decrease the PE ratio. Either prices come down, that might be a market crash, it could just be a correction, or earnings go up. Earnings can come up to meet the prices. That's an option. Not a guarantee, but it's an option. Or some combination of the two. Valuation can tell us something about the conditions we're driving into. It can't tell us exactly when it's going to rain, but the distinction matters a great deal depending on where you are in your financial life. If you're 30 years old investing every month and you don't need the money for another 30 years, a 30% decline is painful, but more of a buying opportunity. You can dollar cost average in at better prices or lower prices, if you will. Nobody enjoys opening a brokerage statement discovering they've involuntarily donated a year's salary to market volatility. But if you're still accumulating, it means your future contributions are at a better value than it was before the market crash. If you're 65, you've just retired, you're about to start withdrawing money from your portfolio, that exact same market decline can be very different. It can feel devastating. Now you're not just waiting for the market to recover, you may be selling investments while they're down because you have to. You need to live off of those investments. You need income. You need those investments to pay bills. The electric company remains uninterested in your long-term expected return. It's not going to wait for the market to recover. So then the question becomes, will the stock market eventually recover? Historically, it has. The better question, I think, to ask is, what happens to my financial plan while I'm waiting? That's where portfolio construction becomes more important than predicting the market. To use a cliche, time in the market matters more than timing the market. Or if you prefer, it's not about the ending of the journey, it's the dividends and interest we made along the way. If you're looking at a market today and thinking, this feels expensive, what should I do? I wouldn't start by trying to guess the date of the next correction. I'd start with your own portfolio, your own goals. Talk to a fiduciary financial advisor. Talk to someone who can help you plan for the worst and hope for the best. How much of your money is actually invested in stocks? How concentrated are you in the companies and sectors that have recently done the best, like technology, artificial intelligence? Do you own different types of companies? Do you have exposure outside of the United States if the US goes through a recession? Do you own bonds or other assets specifically because they may behave differently than stocks? If you're already retired or approaching retirement, I'd ask another question. If stocks fall 30% next year, where does your spending money come from? Do you have cash? Do you have bonds? Do you have other sources of income? Do you have an emergency fund? Have you established a protection bucket? Or would a major decline force you to sell stocks at the moment you'd rather not sell? These questions aren't nearly as exciting as predicting the next market crash. No one's going to go viral on YouTube with a thumbnail that says, review your asset allocation. Although if this video gets 10 million views, I reserve the right to reconsider that statement. It won't. My next video will be a time lapse of paint drying. So tune in for that one. The objective isn't to construct a portfolio that works if your prediction about the future is correct. It's simply to construct one that can continue working when your prediction is wrong. That's diversification. You won't always be right. You won't always be wrong. You'll be right and wrong. And that's okay. Which brings us back to the highway. Sky ahead's dark. Maybe the storm hits us. Maybe it doesn't. Maybe the market falls next month. Maybe earnings continue growing and today's valuations look completely reasonable. Maybe the companies dominating the market continue dominating for another decade. Maybe the next generation of market leaders are companies most of us aren't even paying attention to yet. I don't know. When you're driving towards uncertain conditions, you don't need to know exactly where every raindrop is going to fall. You need to make sure you're not driving so fast that the first patch of water sends you off the road. That's what diversification is. That's what an appropriate allocation between stocks, bonds, and cash can do. And that's what a good financial plan is supposed to do. It gives you room for the forecast to be wrong. So if there's one idea I want you to take away from this, it's this. A good portfolio isn't built around predicting the future. It's built so that you don't have to. Take that stress off. Hopefully that's a relief to you. But it also means that your portfolio of just the S&P 500 may not be diversified enough. You may want to revisit that. Markets will always give us something to worry about. Today it's valuations, concentration, and artificial intelligence. Tomorrow it'll be something else. Financial television has several hours of programming to fill every day. I'm confident they'll find something. They'll keep you watching with whatever the latest spin or headline is. The objective here is to build a financial plan that can survive more than one version of the future. If you found this helpful, please like and subscribe to the channel. That way YouTube gods will honor me with more algorithm credits, more algorithm points. I don't know how it works yet. I'm kind of new to this. I make videos about investing, retirement, and the financial decisions that matter when you're trying to build, protect, and eventually live off of their wealth. I'm Bryan Yach, wealth advisor, owner of Yach Advisors. Thank you for watching. I'll see you next time.